In today's video, I'm going to be going over one of the biggest options trading mistakes I've made to date. Now you might be wondering, why am I going over this? Why am I telling you my mistake? And it's for one sole reason. I want to make sure that you don't make the same mistake that I did. Now before we dive into the actual mistake, I want to give you a little bit of a backstory here so that the context makes sense. First off, I started trading options only about 6 to 8 months ago, somewhere around there, after trading crypto and FX for the last 3.5 years. So I'm relatively new to options and still trying to figure out what my strategy is, what I like to do, etc. As a result, if you've seen some of my previous videos, you know that I recommend starting with paper trading or with a small portfolio until you have comfortability and profitability in whichever asset class you're trading. So personally, I'm trading options with about a $4,000 portfolio right now. That's where I'm comfortable losing at, and it still gives me enough skin in the game where if I win, I'm happy with the wins as well. Now, one other thing I've worked out over time, and something that I'm continually working on, is my risk management with options. Personally, I like to enter option trades with about 10% of my total portfolio, or about a $400 trade. And from there, I'm risking roughly 50% on each trade as the maximum risk that I would take. That's where I would stop out of the trade. So in other words, I'm entering with about $400 and I'm risking about $200 max per trade. Now I'll let that go a little bit over, a little bit under, depending on what the contract prices actually are, but that's roughly my target. About $200 or 5% of my portfolio is my max risk per trade. So what is this mistake that I'm talking about? It has to do with a credit call spread that actually exercised against me. Now I've actually been trading all sorts of different spreads for quite a few months now, vertical spreads, debit and credit call spreads, and put spreads, and this is the very first one that I've had exercised, and it really did not go in my favor. So of course, the very first thing you need to understand before I dive deeper into this mistake that I've made is actually what an options contract is. Now I have an entire video on what options are, and this dives really deep into the fundamentals and the definition behind options contracts and all other sorts of things you need to know in order to trade options, and I highly recommend you check that out. However, for the sake of this video, I'm going to give you a brief overview of what an options contract actually is. If you're buying a call option, that means that you're buying a contract that allows you to buy 100 shares of whichever stock is the underlying stock on the contract itself. So if you're buying an Apple call, you're buying a call contract that gives you the right to buy 100 shares of Apple at whichever strike price your contract says before whichever expiration date it says. So if it's an $85 call that expires on the upcoming Friday, you have until Friday to buy 100 shares of Apple at $85. And you're able to exercise this contract all the way through 5 o'clock p.m. on Friday, 1 hour after the markets actually close. So let's say Apple is $90 and you're still holding this contract at close. You have the right to buy 100 shares of Apple at $85, so of course you're going to go ahead and do that, as long as you have the capital needed to do so. You're immediately going to profit $5 per share of Apple times the 100 shares that you're allowed to buy, which means you immediately make $500 by exercising this contract. Now just keep in mind, when you're exercising this contract, that means someone actually has to be on the other side of it. They have to be the one that sells you 100 shares of Apple. The second fundamental thing you need to understand before I dive into the mistake, and I promise it's coming up next, are what credit call spreads actually are. Now credit call spreads are another type of vertical spread, just similar to debit spreads, which you can do on the call or put side as well. Again, I have videos going over these, and I'd highly recommend you watch those if you want to see more into depth into how to use these, how to utilize them, and what their actual profit and loss potential is. But once again, I'll give you a brief overview. If you're buying a credit call spread, it means you're actually taking a bearish position. What you're doing is you're selling one contract and you're buying a contract that is one strike higher than that one. So for example, you could sell a $400 call on Apple and buy a $405 call. Now, of course, if you've traded options before, you know that the $400 call costs more than the $405 call with Apple. And since you're selling the $400 call, the one that has more value, you're actually getting more value than you're paying for the $405 call. So maybe you're selling the $400 call for $100 and you're gaining $100, but then you're buying the $405 call for $90, so you pay 90 of that 100 back. Now you've been given $10 and that's what you have to keep. Your main objective here is that Apple closes below both of those strike prices. So if Apple closes below $400, both of those contracts will be worth nothing because they'll give you the right to buy Apple at a higher price than it actually closed at the end of day Friday. So if Apple is at $390, of course, the person who owns the $400 call has no reason to actually exercise that because they're buying Apple at a higher price than it actually is. Okay, so you understand those two fundamentals now. Let's actually dive into the trade that I made specifically. So this trade actually happened 5 days ago as of today. It was on November 2nd, and it was at the end of the day. I'm going to put a square around the price history on November 2nd so you can see what I was looking at and I can better explain what trade I took and why. So this encompasses the full day on November 2nd, split into 5-minute candles here. We gapped up in the market and then started trending downwards not long after about 10 o'clock or 10:15 in the morning. The election was also the next day, as we know, and so I thought this was going to continue trending downwards. When I saw this started spiking up around the end of the day, between 2 and 3 o'clock, I was looking for a bearish position. I decided I wanted to take a credit call position in order to try it out and see how the credit call position would work for me here. It wasn't really something that I do a ton, and so this was more of an experiment to figure out, do I like credit call positions, how do they work, and how is the profit potential actually going to look with them? So I did something very simple here, and I used a Fibonacci retracement from our high of the day to our low of the day, and I pulled this sideways. And once the trade got into here, I was looking at it around this green candle and this red candle, and we were just about at this 618, which, if you've seen my other videos, you know this is one of my favorite places to take a trade overall. As soon as this red bearish candle here, this very small one, came in, just nearly wicked that 618, I took a short position. And in order to do this, I used that credit call spread. So let's take a look at the position I opened. So you can see here that I opened this credit call spread at the $330 and $331 strike price. It tells you I sold the 330 strike and I bought the 331 strike, and these were both calls. Now when I did this, the 330 strike was 40 cents more per contract, or $40 overall. And since I bought 4 of these credit call spreads, that means I was immediately given $160. Now, if this trade went against me, the maximum loss that I should have been able to take from this was $240. Again, if you want to know where this math comes from, I explain it in my video on credit call spreads. In order to keep the full $160, I knew that SPY had to stay under that 330 mark, and you can see that this was right around 330.4. So all we had to do was drop down from the end of the day and just lose about 40 cents in value, which I had a really good feeling was going to happen, and then my contracts were going to expire fully in the money for me and be worth $0 each. In other words, I would keep the $160 and I wouldn't have to buy this back at all. And you can see as of about 340, 345, even by 350, we were still almost a full dollar under this 330 mark. So 10 minutes into the normal close, I was pretty excited about this. I thought it was a winning trade and I thought it was going to go super well. At the end of the day, you see the market starting to bounce back. And at the close of the day, we actually ended up closing at 330.2. In other words, the $330 calls were actually worth about 20 cents each, or about $20 total. Now, SPY actually trades its options contracts into 4:15, so this is the time I was looking at in order to actually close off my contract and to see if I actually needed to close this off. If we were significantly below $330, then I wouldn't need to close off my position. I would just keep the money I earned from the credit call spread, and no one would exercise these contracts. They wouldn't be worth anything. However, this was actually mistake number 1 for me. The first thing I didn't know here is that these contracts actually execute based on the closing price at 4 o'clock. So even though the contracts traded up until 4:15, it was the closing price at 4 o'clock that actually determined what you could exercise these contracts at. So 4:15 actually came around and we closed right below 330. It was right around 329.98, and at that point I was pretty happy because my contracts, again, as I've been saying, should have been worth $0. I went to sleep. I thought that the broker would just close off this contract for me. I would keep my full $160 and not have to pay anything back. However, when I woke up in the morning, I was in a major short position. The person who bought the $330 call decided to exercise the contract. And since I had 4 of them, they were able to buy 400 shares of SPY at $330 a piece. Now, if you do the math on that, that's about a $120,000 position that I got myself into in a short SPY position. Now, I was able to be in this position because of my margin account. Basically, this trade was leveraged for me. However, that didn't help on the loss side at all. Since I was short 400 shares of SPY, every single dollar that SPY moved, I would lose $400 too. And remember that my risk management strategy is to only risk $200 per trade. So even half a dollar on SPY would have already stopped me out on this short position. Now here's where the unfortunate part comes in for me. I didn't realize these contracts were executed until pre-market the day before. And at that point, SPY was already all the way up into the deep 333s, almost $334, before I realized that I was in this $120,000 short position. And so by the time I opened my account to look at this, I was actually negative $1,600 on SPY, which is about 8 times what I like to lose on each trade. And just to show you the proof of that, here's me buying back 400 shares of SPY at $334 a piece. A $1,600 loss on my $4,000 portfolio. I lost 40% of my portfolio overnight without even realizing I was going to be in a position. Now this was pretty tough to wake up to, and it even make the rest of the week tough moving forward. However, these mistakes and similar ones are the reason I trade with a small portfolio until I'm extremely confident with trading options and am profitable over a long, sustained period of time. So I really hope you're able to take something away from this video and not make the same mistake that I did. That is the single reason I'm making this video and sharing this mistake. Even though it was extremely painful for me to wake up to, I'm glad that I can teach my lesson forward and hopefully help one of you not do the same thing. If you like this video and want to see more content on options or trading in general, please click the like button below and hit subscribe for future similar content. I really appreciate all of your support.